Good day, ladies and gentlemen. This is Barry Norman on behalf of Investors Trading Academy, and welcome to our webinar about understanding what the NASDAQ is and trading commodities on the NASDAQ exchange. Now, the NASDAQ commodity family provides a broad way to track the U.S. dollar-denominated commodities traded on U.S. and U.K. exchanges. NASDAQ's transparent and rule-based selection criteria result in a diverse index family with significant exposure across major commodity sectors. On the NASDAQ, you can trade from metals, energy, agriculture, livestock, and a broader sector of individual commodities. The NASDAQ Commodity Benchmark Index includes 32 commodities and provides a broad and representative exposure to the commodities market. So as you can see here, there's an entire list of standardized NASDAQ contracts, starting in alphabetical order or starting in groups ranging from Brent oil, which is the most highly traded, all the way down to feeder cattle. All the contracts are standardized. You can see here what the contract size is, what exchange you're traded on, and what form or what volume they are traded in. NASDAQ has been in the forefront of setting the standards for transparency and efficiencies for the Nordic energy market for more than 20 years. Our extended product range now incorporates products traded across continental Europe to include Germany, Nordic, and UK power cells. So not only can you trade US and UK, you can now trade energy markets throughout the major capitals of Europe. NASDAQ Commodity is the brand name of the NASDAQ Inc.'s worldwide suite of commodity-related products and services. The NASDAQ Commodities offerings include power, natural gas, carbon emissions, tankers, dry cargo fuel, fuel oil, seafood derivatives, which is a new popular field, iron ore, electricity certificates, and clearing services. NASDAQ futures bring a competitive mix of new product fees and innovative technology and clearing services into the mix. Now, under the power sector, the power products offered by NASDAQ Commodities comprise of Nordic, German, Dutch, Belgian, French, Italian, Spanish, and UK power derivatives. The derivatives are future deferred settlement futures, options, electricity price area differentials. So you have many choices of other ways to trade than standardized buying and selling of standard energy contracts. Now, some of the advantages of trading power through NASDAQ include it's Europe's largest clearinghouse. It's one of the fast and most efficient, functional, complete multi-asset trading systems. It's cost efficient and low latency, and you've got the representation, or you've got the reputation of NASDAQ. Sorry. NASDAQ Commodities offer trading and clearing financial service derivative contracts. They offer base and peak load futures, monthly average rates, deferred settlement futures, a broad range. There is no physical delivery of financial power contracts. They also are the market maker. A market maker is a member who commits to continuously quote, buy and sell prices on the exchange. The exchange requires that the market maker quote a maximum spread between buy and sell ratios. They are required by minimum volumes quoted, and the matrix is based on volatility and price levels. So as you can see here, they are the market maker for many of the energy contracts. And sometimes you're better off trading through fast, reliable market makers. Under electricity certificates, NASDAQ Commodities provides trading, clearing, physical delivery of electricity certificates. Under the Scandinavian electricity certificate offering, NASDAQ Commodities provides trading and clearing of electrical certificates and physical delivery to designated clearinghouse accounts. Then they cover freight. The exchange transaction offered by NASDAQ Commodities comprise of dry and tanker freight futures and option contracts, a new way that you might consider trading. The dry and tanker derivatives contract provide are linked to standardized freight routes or a basket and types of vessels. Now, just a year ago, we were talking about the cost of fuel transport was getting very, very high because so many freighters were being used for storage of physical oil. And you could have been buying into those prices to sell once we started clearing out the cost of clearing out oil backlog, and the cost of the freighters or freight would have gone down. So there are many easy ways that you can use these unusual types of commodities to trade in the global markets. Then we also have metals. We have futures and options provided by the NASDAQ in metals contract. We also have another popular growing one, carbon. Okay, carbon is becoming one of the biggest traded commodities on the exchange. And then we have seafood derivatives, salmon market, and the NASDAQ Salmon Index. NASDAQ offers clearing of salmon derivatives traded on the third-party exchange, Fishpool ASA. The clearing services can be accessed by all NASDAQ financial and commodities markets. The salmon derivatives are in compliance with the current regulatory requirements and settled against the Fishpool Index for fresh superior Atlantic salmon head on gutted. Okay. Now, again, offers new ways to trade in the markets. So let's understand how to trade futures. In the United States, trading futures began in the mid-19th century with the establishment of the central grain markets where farmers could sell their products either for immediate delivery, also called the spot or the cash market, or for forward delivery. These forward contracts were private contracts between buyers and sellers and became the forerunner of today's exchange-traded funds contracts. Both forward contracts and future contracts are legal agreements to buy and sell an asset on a specific date during a specific month at a specific price. While forward contracts are negotiated directly between a buyer and a seller, the settlement terms may vary from contract to contract. A future contract, if facilitated through a futures exchange, is standardized according to quantity, quality, delivery time, and place. The only remaining variable is price, which is discovered through an auction-like process that occurs on the exchange trading floor or via electronic trading platform. Conventionally, traders are divided into two main categories, hedgers and speculators. Of course, we would fall under speculators. Hedgers use the futures market to manage price risk. Speculators, on the other hand, accept that risk is an attempt to profit from favorable price movement. While futures help hedgers manage their exposure to a risk, the market would not be possible without the participation of speculators. They provide the bulk of market liquidity, which allows the hedgers to enter and exit the market in an efficient manner. Speculators may be full-time professional traders or individuals who occasionally trade. Some hold positions for a month, while others rarely hold them more than a few seconds. Regardless of their approach, each market participant plays an important role in making the futures market an efficient place to conduct business. So, what types of trades are there? Hedgers have a position in the underlying commodity. They use futures to reduce and limit risk associated with the adverse price change. Producers such as farmers often sell futures on crops they raise to hedge against a drop in commodity prices. Then we have individual traders. That's you and me. Many speculators are individuals trading their own funds. Traditionally, individual traders have been characterized as individuals wishing to express their opinion about or gain financial advantage from the direction of a particular market. Electronic trading has helped to level the field for individual traders by improving access to price and trade and speed. Portfolio managers, on the other hand, or investment managers, are responsible for investing and hedging the assets of mutual funds, electronically traded funds, or closed-end funds. The portfolio manager implements the fund's investment strategy and manages day-to-day operations. Then we also have proprietary trading firms. Okay. Hedge funds and then market makers, of which NASDAQ is. Market makers are trading firms that have contractually agreed to provide liquidity to the markets. Why trade futures? Futures provide a fast and cost-effective way for you to access financial and commodity markets around the clock. Increased interest in global markets has accelerated media attention and attracted the interest of traders from around the world. From their study of the markets, traders develop a perspective of the direction of commodity prices, energy prices, metal prices, currency, interest rate, and stock indices. NASDAQ offers products across the major asset classes, giving you a direct and transparent method of acting on your insight and participating in the markets. Now, there is leverage on futures contracts. Leverage on future contracts is created through the use of performance bonds, often required as a margin. This is an amount of money deposited by both the buyer and the seller on a futures contract and the seller for an option contract to ensure their performance of the contract. The performance bond may represent only a fraction of the total cost of the contract, often 3 to 12%, making futures a highly leveraged trading vehicle. Therefore, future contracts represent a large contract value that can be controlled with a relatively small amount of capital. This provides the trader with greater flexibility. So it allows you to maximize capital efficiency. So what do we mean by leverage? Say, for instance, the E-mini S&P 500 stock index contracts could cost a value of $60,500. But you would be able to buy or sell this contract by posting a performance bond of about $6,000, which is 9% of the value. The ability to leverage may remind you of buying stocks on margin. However, in equity markets, buying on margin means you borrow money to make a purchase. In the futures market, your performance bond is not partial payment of the product. It is good faith money you post to ensure that you're able to meet the day-to-day obligations of holding that position. Now, there's also financial safeguards, because when you're trading on NASDAQ, which is a fully regulated exchange, you know that you are safe with over-the-counter and central counter clearing models. Okay. So how does it work? Before we go through specific examples, here are some contract size. The definition, each future contract has a standardized size that does not change. For example, one contract of corn represents 5,000 bushels of very specific type and quality of corn. If you're trading British pound futures, the contract size is always for 62,500 British pounds. The E-mini S&P 500 futures contract size is always 50 times the price, $50 times the price of the S&P 500 index. Then there's contract value. Contract value, also known as a contract notional value, is calculated by multiplying the size of the contract by the current price. And then there's tick size. That's how much it costs you each time it moves up and down a simple tick. The minimum price change on the future or options contract is measured in ticks. A tick is the smallest amount that price of a particular contract can fluctuate. Tick size varies from contract to contract. A tick in the E-mini S&P 500 future contract is equal to 1/4 of an index point. Since the index point is valued at $50, the 1 point is equal to $12.50. There's also price limits, mark-to-margin events, margin calls. Okay, and so to give you a real-world example, hedging corn. Corn farmers, like other producers, are at risk of changing prices. If a harvest is good and demand is low, corn will be abundant and price may fall. If a harvest is poor and the demand is high, prices may rise. To hedge against falling prices, corn producers may turn to futures market. In effect, they will use the futures contract to hedge the sale price of their crops. Producers may hedge all or part of their crops depending on their market outlook. Producers are, in effect, long the actual or cash commodity. So to hedge their risk, they attempt to take equal, both opposite short positions in the future market. By selling futures, producers producers are able to transfer some of their risk to another market participant. The farmer sells corn futures to hedge the risk of owning or being long the cash commodity. If corn prices fall, the farmer will be able to buy back the futures at a lower price. If the profits make up some of the losses the farmer will incur when he sells out his harvest, the risk is transferred to the person who buys the future. You can also hedge currencies, similar the same way, and you're buying contracts of currency in the futures market. It's different than trading on the Forex. Okay? It's also different than trading CFDs. Okay? If the U.S. company was buying euro currency commodities, who was selling them? Any number of market participants might have taken the other side of this trade. A company hedging against the possible decline in the value of the euro, a spectator looking to take advantage of this, or a European company buying product in the U.S. It could be either. But the difference is here you are actually buying the contract for the physical currency, where in the Forex market you never have access to the underlying value, and it's just on relative values up and down in the marketplace. Okay. So in this case, you have a standardized contract with a standardized delivery date and due date, as opposed to a Forex trade, which is going on, you can keep alive as long as you want, and you have all the market volatility. So on the NASDAQ, you can trade with stop orders, limit orders. You can trade just like you trade any other broker, but now you're trading through NASDAQ offered commodities, which make those commodities a lot safer and a lot more secure and a lot more regulated. And you calculate just like you do any other contract. So how do you get started? Well, once you're ready to start trading futures, it's good to first take the following steps into your path. Begin with simulated trading. Find a demo account. Before you begin, it's important to become familiar with the markets you plan to trade. A simulated trading account will allow you to trade, to place trades, cancel orders, gain valuable experience while implementing the concepts as discussed. Pick 2 or 3 markets to follow and experiment with various trading plans. An electronic trade simulator will help you replicate real-world trading conditions. It's a good way to become familiar with price quotations, market terminology, and general behavior of the markets. Trading simulators are also offered by a number of brokerage firms, or you can get it right on the NASDAQ. Okay. Then once you're ready, you will either look for a full-service broker or a discount broker offering NASDAQ futures contracts on their site. But select a good broker. Before placing your trade, you need to open an account with a registered futures traders who will maintain your account, guarantee your trades. In the futures business, brokerage firms are known as either future commission merchants, FCMs, or introducing brokers, IB. Many securities brokers are also registered to deal in futures. You may want to see if your current broker can provide you this service. But futures trading is different than CFD, Forex trading, or the standard online trading. Okay. So you need to make sure you can find or that your current broker offers that. Also be sure that check their background and any potential broker, and make sure that they are approved by the Natural Futures Association, the NFA. And with future trading, it's just a matter of sticking with a game plan, knowing how much size you're going to trade, how many contracts you're going to trade, and knowing your risk. Don't get emotionally involved or tied to a trade. When I started to act on my intuition, I started to be a little bit better, more aggressive, and things started to go my way. So determine the right size of your trading account. Have a trading plan. Stick to your plan. Set definite risk parameters at all times. Diversify. Know your positions. Every seasoned trader should continue to educate themselves on the market to stay up to date with the latest development and new learning opportunities. So thank you very much for joining us, and try trading futures through NASDAQ. Check out your brokers. Find a broker offering you NASDAQ offered futures commodities for regulation, transparency, dependability, liquidity, and quick execution. Thank you very much, and try moving over to trading futures. They're a little bit more advanced, they're a little bit more sensitive, but they're more of an investment than they are a risky trade. So thank you very much for being part of our webinar today, and give NASDAQ futures a shot out there. Thank you very much, and have a great weekend. Bye now.